Welcome to Random Gleanings. He's Jesse. I'm Chris. Jesse, I thought we this week do a analysis of pros and cons. Things have gotten better in the last 45 days.
That's right.
It's probably time to take stock, right?
I think that's fair. Yeah, let's do it.
Yeah. So from a dashboard standpoint, the items we highlighted are the ones that we're going to spend the most time on. So first chart, peak inflation. Has inflation peaked?
Based on the CPI report that came out, last week or the week before, I guess, it would seem as though that's a likely outcome. Yeah.
I mean, you got to take it as, less bad is better, right?
That's right.
So that's good.
Certainly a positive. That's right.
Yep,
So it falls in
it's
the green
pro.
camp.
That's
Yep.
right. Freight rates coming down and rail volumes coming down. I mean, that would seem to be better, right?
Again, I think that's going to support the inflation numbers and speeds things up, right? So yeah, that's a good thing.
I mean, you would think businesses like to pay less for shipping and rail cars, and I don't know about air flight at this point, but certainly shipping and rail cars. Next chart, delivery times coming down, right?
Yeah, that's right. Again, that's got to be a positive. There's no question.
Yeah,
got to be a positive.
Feels like supply chain is getting better.
Is improving.
Definite pro.
Yep.
All right, so we're finishing second quarter earnings right now, and you've had 91% of companies reported as of yesterday, and yesterday would be August 16th. And so far, 75% of those companies have beaten their earnings by about a 2% average surprise. The only double-digit plus was energy. The only double-digit negative was communication services, which would include, let's see what, Google.
It's Google for sure. I think
Facebook. Yeah, Meta, excuse me. Yeah, so, I mean, energy good, Google and Facebook, maybe not. I mean, that's sort of discretion. That's an interesting thing, I think.
Well, and the funny thing is, if you look at the stocks that are included in those sectors, there's been an inverse relationship to those numbers right now.
Right. Good point. And if you look at, if you look on that chart at the three negatives from a sector standpoint, they were technology, consumer discretionary, and communication services, which covers a lot of ground. But consumer discretionary, the two largest holdings are Amazon and Tesla. And then again, communication services, I'm pretty sure that Meta and Google are
they are, and technology is going to be Microsoft and Apple. So yeah,
right.
Those stocks have run off of those negative surprises, whereas the energy sector has crumbled since.
Yeah, right. Earnings have been good, but energy's certainly been down in the last little bit. Also, the surprise from an earnings standpoint has not been as big as it normally is either. Maybe something to talk about.
But still in the
not
pro
bad.
camp right
now,
right?
Pro
Yeah.
camp because it's still not bad. It's not bad.
Right.
It's okay.
Yeah.
It's still pretty supportive. So that's a pro for sure. All right, next chart. We had back-to-back quarters of negative GDP. We've talked about whether that's a recession or not. If, there are plenty who would argue, including the current administration, that no, that doesn't represent a recession. And one of the points you can point to in that regard is unemployment dropped to 3.5 from 3.6 this month. So
we'll get back to that.
Yeah.
But so, I mean, in on that chart, this back-to-back negative GDP chart from 1950, there has been some positivity after we've logged, two negative GDP quarters.
Yes, especially so next chart, yeah. So especially out 6 months, 1 year, absolutely. Now, if you look at the 3 months following, you've had a median of about 7.5% return. Okay, but it's less. The batting average is less good on 3 months than it is on 6 years or 6 months and 1 year. Also, I'll say this: since June 30th, the S&P is up over 12. So that's over the median already, and I'm sure it's over the average of those numbers as well. So, okay, but it's a pro, right? You look forward, you normally see things better. All right, next chart. Election cycles, right? This is the second year, it's midterm year, right? Um, Generally, stocks are not as good in the second year in that midterm year.
Right.
So, I mean, we're entering a period that historically, presumably, should be more positive. You can see on this chart, percentage of time the second year's up is just over half. Third year is usually overwhelmingly positive. So, it'll be interesting heading into next year for sure.
Absolutely.
All right. So, let's look at the other side of the coin. So, you hear all the time about don't fight the Fed, right?
Talked some about this last week. Yeah.
Yeah. So don't fight the Fed. When they're lowering interest rates or they're printing money for the economy, don't fight the Fed. Right. That's
Hold assets.
that's the
right.
mantra.
Yeah.
So what now? Okay, because the Fed is on fire.
The Fed is fighting inflation,
Yes.
which is basically fighting asset prices.
Yes.
Right.
And here the market is kind of fighting it, or a lot of folks seem to be fighting it. And I'm not saying they're wrong. I'm just saying, boy, I mean, what do you do? I mean, when the mantra is wind at your back,
Participate, yeah.
what do you do with the winds in your face?
That's I, there's not a great track record for them fighting inflation or whatever, raising the rate and tightening, to support asset prices.
Right. So look at the chart on the right, okay? And I thought this was a really interesting point made by our friends at Bespoke. The Fed is tightening at the fastest pace since 1981 in a much more debt-sensitive economy than the early 80s. So what does that mean? What that means is more people have more debt outstanding than they did back in the 80s.
That will be affected by those interest rates.
Right.
Right. And so that's a very different setup. And I know you've highlighted this before too, and we've talked a lot about multiples, don't have to go there today. But the multiple back in 81
was 9.
Was 9.
9 times earnings.
Right. So
it is not 9 times earnings now.
It's 19 or something, right?
18 somewhere there,
right.
but we'll talk about that later.
So.
All right, next chart. So food inflation. So this was, yes, less bad is good when it comes to CPI. But food inflation does not seem to be getting better. I remember about 6 months ago, we talked about one of our strategists sort of anecdotally talking up in the Northeast about food prices, and they were starting to hear evidence of them coming down. I'm talking to folks, Chick-fil-A franchise owners, financial folks at regional gas providers that offer food as part of their inside
Convenience store, right.
convenience service, right? You say something like, "Hey, I'm hearing food prices are coming down," and they are shaking their head no. Okay, and here it is, right here on the screen. This is the worst food inflation we've had since the 70s. We've only had a couple periods like this. And so what happens now? Back in the 50s with the Korean War, you had a supportive Fed that was using quantitative easing. I mean, all those bullets are out of the gun this go around.
That's right.
And so, we don't have Fed winds at our back as we just talked about.
And while we've seen gas prices come in, and most people use gasoline, right?
Right.
Everybody's got to eat.
Everybody's got to eat.
So it's going to be one of those things that's so tactile, right?
Yes.
In all of our daily lives.
And it's 15% of the CPI
Household
number,
spend, right?
I think. All right, next chart. So if this is a bear market, right? I mean, we were down over 20% on the S&P. If this was a bear market, it was a really quick one.
Right.
164 days.
Yep. The 2020 obviously was much shorter, I think somewhat explainable, but on average, 164 days is right near the middle mark of the average bear market.
Yeah.
So we're both shallow on the average at a 24 from peak to trough to this point, and short.
Okay. Next chart. Um, if we give any consideration at all to what folks out in the economy are telling us, this chart is the New York Fed manufacturing general business conditions. It is not very positive. And you're seeing more of this. I mean, you're seeing leading indicators kind of dropping. I don't want to say off a cliff. That sounds a little bit inflammatory, but I mean, look, they're not good.
They're not good, and you can obviously see back to some periods where those leading indicators were pretty right on and a warning signal. So,
Right.
yeah.
Right. Okay, next chart, housing. I know we're going to have a future RG episode just on the topic of housing because it is so involved. But just suffice to say that housing is not particularly positive at the moment either.
It has gotten considerably more expensive, and for first-time home buyers, it is almost unaffordable.
Yeah.
Yeah.
Okay. All right, next chart. The yield curve. Okay, tell us about the yield curve.
Well, it's one of those things that I think is discussed somewhat on the news, and we've talked a little bit about in the past. But there is trouble awry historically when a shorter duration bond is paying more than a longer duration bond.
Which is happening right now.
It's happening.
Between the 2-year U.S. government bond and the 10-year U.S. Treasury bond. The 2 years paying more than the 10-year.
That is correct. And, again, from a risk reward standpoint, it just doesn't make sense generally for that to be the case. Okay. And so that has forecast recessions in the past.
Yes.
And we find ourselves in the situation. Happened back in April for I think you called it a quick minute,
nanosecond. Yeah.
nanosecond, and we've been in that scenario since July 6th of this year.
So our friends at Data Trek have shared it's usually not the first inversion that gets you or starts the clock. It's really the second inversion. And the second inversion happened on July 6th. And that's in the purple line. And you see the circle there around July 6th. Okay.
Right.
So why is that relevant looking forward? Well, if you look historically at the average performance of the S&P 500 once the yield curve inverts 12 months out, it's 5.4%, right?
Right.
And we've also got on this chart the 10-year and the 90-day Treasury as well.
Right. So a 90-day Treasury inverting against the 10 is apparently a stronger signal towards the start of a recession. Okay.
Right.
And, we have not crossed that threshold to date, but you can see on that chart, the yield curve chart,
Since May, it's
since
gotten
May,
way the heck
it
closer.
has gone way off. That's
Yeah.
right.
So if we look at the 3-month versus 10-year comparison, if the 10s and 3 months invert, you've got average annual next year performance when it's happened of negative 0.4%.
That's right. And so put those two together, I think you had a really interesting thought in regards to, okay, 2s and 10s have inverted, positive a year later at 5.4% average, but we've returned
Since July 6th, the S&P's up 11%. Okay, so that's over double the 5.4 number. And I mean, listen, nothing moves in a straight line, right? But it at least gives you some pause about. I mean, one of the things you'll hear a lot is 2s, 10s invert. Well, I mean, it's positive for the next however long. Okay, that's great, but by how much and what have we gotten on average over time 12 months out from that inversion?
That's just it. That's right. So again, I think as we're just trying to show a balance of what's positive, what's negative in this market, this clearly doesn't hold a lot of good juju.
That's why it's a con. So we've got a couple neutrals in here. Just kind of, I mean, are they pros? Are they cons? Are they just observations, right? Are they random? Are they random gleanings? So, okay, this is from our friends at Bespoke. Forward PE ratio of 18.1 times earnings. All right, so it looks like it's come down, right?
Mm-hmm.
I mean, that's good. But we've talked a lot about the rule of 22, right?
That's right. Yep. And right now that would imply that the PE or the multiple ought to be closer to 17.
Right. 3% long-term inflation off of 20 implies you ought to be around a 17 multiple.
That's right.
But you and I have talked about the fact that historically, if you've got a 5 to 6% CPI, so inflation, right, that the PE from 1900 to 2021 on average has been 15 times earnings.
Right.
And we're at 18.1.
Right.
And we're also at 8.5 on the CPI.
Right. Right.
And by the way, north of 6 to 10 on the CPI was 13 times earnings. But, not getting crazy, just saying, hey.
So why not solidly in the negative camp? I think it's because PEs have come down. Whether it's been discussed in this podcast or not, there's some argument that PEs will be elevated with low interest rates, right? It's a hard call right here, but at the same time, it's something that we're keeping an eye on.
Yeah.
So,
all right, last chart of the marathon chart session here. So this is a chart as of this morning. And what you can see is the yellow line represents the trend from January 3rd, the top, until now. And we're a little bit over the halfway point back from the bottom, but now we're bumping up on that trend. And so that's a noticing, right? Is that a pro or a con? Well, I mean, if we break through the trend, it would imply a pro, potentially. Mm-hmm. Potentially. Doesn't mean it's a pro, but it does mean it's
a
notable.
Signal. It's a signal, right? It's not.
Correct.
It doesn't mean that anything has for sure changed in the overall scheme of things, but at the same time, it's something you have to give notice of.
Yep.
So
that's right.
But we're right there, and so that's why this one absolutely falls into the neutral camp. Time to keep an eye on this.
Yeah. For sure. In fairness, the NASDAQ and, small caps, the Russell 2000, have broken through that line.
Right.
But the big question is all right, well, if you've got the potential for rising interest rates, then, from here, then what does that do to growth stocks, which certainly, the NASDAQ and the Russell 2000 would be a little more in that camp.
Right. So just for context, we oftentimes will show the chart of the S&P as a broader index of the market, just because it's going to encapsulate more sectors of the economy.
That's right.
More fairly.
That's exactly right. Well said. All right. That's all I got.
Yeah, man. Hey, listen, school's back, so welcome back to school for you kids. Parents, hopefully that's a good thing as you all get back into routine. Hit subscribe, share it with a friend. We'd love your support, and thanks for watching.
See y'all soon.